Hey everyone, welcome back to Corporate Decoder, the place where we peel back the layers of corporate filings to find the juicy bits within. Today we are diving into Simply Good Foods company's latest quarterly report where it looks like things are getting a bit complicated. Let's see what the numbers tell us. Simply Good Foods is the company behind popular brands like Quest, Atkins and Owen, giving us those protein-packed snacks and low-sugar treats. They operate in the competitive healthy snack market, so every quarter really matters for them. Right off the bat, let us look at the top line. For the 13 weeks ending the 29th of November, 2025 net sales were $340.2 million. Now that is a tiny decrease of 0.3% from the same period last year when they brought in $341.3 million. It sounds small, but even a little dip can signal bigger issues. The report mentions this was mainly due to some distribution challenges with Atkins and a slight dip for Owen. Quest, however, saw some growth really picking up the slack, though not enough to push sales higher overall. Now let's talk about what is left after they pay for the ingredients and making the stuff. This is the gross profit, and it truly tells a story. Gross profit dropped by a significant 15.8% down to $109.9 million. This means their profit margin took a hit, falling to 32.3% from 38.2% last year. Big reason here, they cite a higher commodity expenses and tariffs. So basically the cost to make their products went up and they weren't able to fully pass that cost onto US consumers. This is a classic example of margins getting squeezed. On the flip side, their operating expenses actually went down a bit by 4.7% to $72.3 million. Selling and marketing costs decreased by about 10%, mainly because they cut back on Atkins advertising for this period. General and administrative costs stayed pretty much flat with a slight decrease, which is good. They did incur about $2.8 million in loan transaction fees related to a new credit agreement, which is a bit of a hit. But hey, sometimes you need to spend money to make money right, or in this case, to restructure. Let us talk about debt. Interest expense dropped by a notable $3.6 million to $4.3 million. This is good news as it reflects some principal payments on their term loan. However, this is a bit of a narrative twist because while this interest expense went down in the short term, they actually took on more debt overall. On the 19th of November 2025, they amended their credit agreement and increased their term facility, borrowing by $150 million. So while they are paying less interest now on the existing debt, they now owe a lot more. The total outstanding balance on this term facility is now $400 million. They are not required to make any principal payments on this for the rest of this year, but the whole lot is due in March 2030. And what does all this mean for the bottom line, the net income? Well, for the 13 weeks ending the 29th of November 2025, net income was $25.3 million. This is a pretty substantial drop from last year's $38.1 million. That is a decrease of over $12 million, or about a third. A big chunk of this comes from that lower gross profit we talked about earlier. Now, the company also likes to talk about something called adjusted EBITDA. This is basically their profit before a bunch of things like interest, taxes, depreciation, amortization, and other specific costs. For this quarter, adjusted EBITDA fell by 20.6% to $55.6 million. Again, this highlights that profit squeeze they are experiencing. Interestingly, even with these mixed results and increased debt, the company continues to buy back its own stock. In the latest quarter, they repurchased nearly 5 million shares for about $100 million. This is a big investment in themselves. They still have about $71 million left on their repurchase program and even announced more plans to increase it in January. This signals a strong belief from management in the company's future value shows. Looking at their balance sheet, we see their common stock outstanding is around 103.9 million shares. The value of additional paid-in capital is substantial at $1.3 billion and retained earnings are climbing steadily to $616 million. However, their treasury stock accounts for over $230 million, which is essentially the value of stock they have bought back. Their long-term debt is sitting at $396.7 million. Remember that increase we talked about earlier, this is where it shows up. And then there are their intangible assets, brand names, customer relationships, etc., totaling over $1.2 billion. This is a massive asset for a consumer goods company, and it shows the value of their brands like Quest and Atkins. Now, if we zoom out a bit and look at the brands themselves, North America accounted for about $331.8 million in net sales. Quest is by far their biggest driver here with over $210 million in sales for the quarter. Atkins is seeing declines with $90.3 million and Owen is holding steady with $31.2 million. International sales are a small sliver of the business, bringing in $8.4 million. Let us talk about the people running the show. The company recorded about $3.1 million in stock-based compensation expense. This is how they reward their employees and executives through stock options and units. It is a significant cost, but it aligns the interests of the employees with the shareholders. When it comes to where they operate, the company has significant lease commitments with over $54 million in operating lease liabilities. Most of this is long-term. Now, every company has risks, and Simply Good Foods is no different. Their main concern continues to be economic conditions like inflation, supply chain issues, and consumer spending habits. They are also heavily dependent on their main brands Quest and Atkins, which means if one of them stumbles, it could really hurt. Thankfully, there are no reported defaults on their senior securities, which is always a good sign. And finally, let us look at the really technical stuff. This filing includes an amendment to their credit agreement from November 2025. This amendment details the increased borrowing and extended maturity dates that we discussed earlier. It is important because it outlines the financial backbone of the company and shows how they are managing their debt. So what is my take on all of this? Simply Good Foods is navigating a tough economic environment. Their core brands are still strong, especially Quest, which is a real growth engine. However, the pressure from rising costs and challenges with the Atkins brand are impacting their profitability. They are making strategic debt moves to fund operations and boost shareholder value through buybacks, which shows confidence but also increases their financial risk. It is a balancing act. We will have to watch closely to see if their pricing and cost-saving efforts can offset these margin pressures. Alright, that is our deep dive into Simply Good Foods' latest report. What do you think about their strategy and their financial health? Let me know in the comments below. If you found this breakdown helpful, please give this video a like and subscribe for more. And hey, do not forget to join our Discord community for even more corporate insights and discussions. The link is in the description. Thanks for watching, and I will see you in the next one.